Computer. There we go. All right. Good morning and good afternoon. I'm Timothy Yee with Green Retirement. Today's talk on long-term care is in partnership with Joe Taylor of Nationwide. Before we dive into the presentation, I must say that Green Retirement, Independent Financial Group of San Diego, my back office, and Nationwide are separate entities. We're not talking about investments today, but past performance is no guarantee of future results. Member FINRA SIPC. Going to be welcoming in Joe Taylor. Joe, I'm still struggling with the fact that you're a Buckeye from Ohio. You have had some football success. All of you who know me, I'm a Cal Bear. Joe's team does know how to get to the college playoffs. Apparently, in his freshman year, they were the national champions. For reference, Cal last made it to the Rose Bowl January 1st, 1959. And the Cal Bears last won the Rose Bowl January 1st, 1929. Entire generations of Bears have come and gone. Cal could not find the Rose Bowl. If you drove them down to Pasadena, parked the bus outside the stadium, and said, guys, we're here, they would get lost. I guarantee it. They could not get into the Rose Bowl. So, Joe, we're not here to talk about college football, but long-term care. This really has come up as a conversation, folks, based upon emails I've gotten from employees, as well as some of my employers in California. They are extremely concerned about what, at the beginning of the year, we thought was going to be a long-term care mandate. The long-term care mandate is based upon the state of Washington. It comes maybe in the form of a payroll tax. And against that background, I thought, well, let's get a long-term care expert in to explain what is long-term care, what could these mandates look like, and Joe has graciously volunteered from Nationwide. Joe, do I have to sing the Nationwide jingle before you start, or is that okay?
We'll close it. We'll make everyone sing. So I'll
Oh,
save it to
okay.
the end.
All right, we'll do the Nationwide is on your side. Maybe I can have Peyton Manning and
Trying to
Brad
keep hearing
Paisley.
it in my head. It's a good.
I got the earworm. All right. Well, Joe, lovely to have you here. Go Buckeyes, go Bears. Tell us what you got on the docket.
Appreciate it, Timothy. And don't worry, I am also a Cleveland Browns fan. So I am used to an extended period of time of not winning, no success. I think we didn't win a championship since the 50s and the 40s. So don't worry, I feel some of your pain as well. While I am a Buckeye graduate, I grew up in Cleveland, so my teams are unfortunately the Cleveland Browns. So we got a
Okay.
chance this year, as we always say, but doesn't seem likely. So I feel your pain there too. But I'll go ahead and get started today, and I'm going to share a little bit of background about myself and a quick personal story before I get into the presentation. But before we do that, I really just want to say thank you all for joining us and listening in on the recording. This is a very near and dear subject, and I'm very passionate about long-term care, and it didn't really click for me about how important this subject is when it comes to the financial plan. So a little bit about me. I have been with Nationwide for the past 10 years. Started right out of Ohio State, and the entire time I've been helping financial professionals and their clients learn about life insurance and long-term care. And I really enjoyed the conversations of helping people find solutions for their problems, helping them understand the products that they own. I mean, you think about it, these are meant to last a lifetime. So somebody who's had this and calls in to learn more about it, why did they purchase it? What features they have? I really enjoyed those conversations. So recently I was able to take a role to where I was solely focused on long-term care. And it didn't click to me that I was in the right profession until I had a personal event happen to me. And so if we rewind back to when I was in high school, I actually worked at my mom's nursing facility. She was a nurse. She's been a nurse her entire life. So she's been taking care of people her entire life. And when I first started working at her facility, I was in the kitchen. So I was just feeding, yeah, feeding the patients there. And then the next 2 years, I worked in the maintenance crew where I was actually able to go into people's rooms and help fix minor things, paint walls, help them change the channel on the TV. That was probably the number one thing that I got asked to do. But I really got to experience my mom as a caregiver, and she was an amazing caregiver to strangers that she didn't know until they entered her facility. Some of these patients would be there for multiple years, so she would, make relationships with them, and I got to see that firsthand. So fast forward to when I'm at Nationwide. I've been there, we'll call it in my 5th year at Nationwide. I remember getting a call from my mom, and she told me that my grandmother had a stroke. So my grandmother lived in Florida. She lived in Florida for the past 30 years. She lived independently on the 2nd story of a retirement community, by herself, went to church every day, was very active, and one day she had a stroke. So her family, thankfully, they have a big family I have 7 aunts and uncles. They came together. They figured out, how are we going to take care of grandma down in Florida? I have 2, an aunt and uncle who live nearby, but they don't have the same background as my mom, who is the professional caregiver. So they immediately called her to ask her to step up and help out. So she spent multiple months flying back and forth down to Florida to be her caregiver. And to see someone that you love and care about have to take care of somebody else that they love and care about, it's totally different than taking care of a stranger, which she did professionally for 30 years. And so I got to go down and visit grandma, and things were getting worse. She was losing cognitive ability from the stroke. She lost mobility in her right arm. And eventually it became too much for her to be able to stay in Florida, and my mom to go back and forth. So we had to move her from Florida up to Ohio so that she could move into my mom's facility, so that my mom could be her caregiver full time. And so I'll never forget it to this day. And this is where it really clicked for me, is why I'm in the right profession and why I really am passionate about long-term care, and really emphasizing why people should put together a plan for long-term care. I get a call from my mom. She's telling me the news about how we're going to move grandma from Florida up to Ohio. And she said, "You know what, Joe? You know what grandma really wants? She wants to go home. She wanted to go back home where she was most comfortable, where her friends were nearby, where she spent the last 30 years of her life. Unfortunately, she couldn't. She lived on the 2nd story. She couldn't take care of herself anymore." So that's when it really clicked to me about how planning for long-term care to meet that loved one's goals, we wouldn't know that unless she expressed that early on. And so if there's one thing that you take away from today's conversation, is to have that conversation with your family and friends. Have that conversation about planning for a long-term care event with your advisor, and really figure out how you're going to plan for that when that day might come. Because sure, you're going to have to step up and, be that caregiver when that time comes. But if you have a plan in place, it could really reduce some of the emotional and physical stress that it puts onto you, not to mention the financial stress. That people will figure that out. But I think the emotional and physical stress is what really puts a toll on people, because they don't know it until it happens to them. And ultimately, we moved my grandma up. I got to spend a lot of time with her before she passed away. But the sad part was, on top of that, is my mom couldn't go back to being a nurse. So she had to essentially retire, because taking care of strangers or taking care of somebody just reminded her so much of taking care of her mom, that it was too much of an emotional toll on her. So what I really want to stress today, and we're going to talk about things that you should be asking or thinking about when it comes to putting a plan together, but have that conversation. And if you haven't had it or thought about long-term care yet, please do, and talk to somebody and put that plan together in place. There's never a wrong time to put together a plan, whether you're very young for what you might initially think somebody should be having that long-term, or you might be older and you might think it's too late. It's never too late to put together a plan. So I just want to share that with you. We'll go ahead and get into the presentation today. Here are the nationwide disclosures. I will not be reading those out loud, but you can see we've got those disclosures there. So what are we going to cover today? So we talked about it with my story about why it's really important to plan for long-term care. We're going to spend a lot of time on that, give you a little bit of background about the costs of long-term care and what's out there. What are your options? And hopefully at the end of this, you can take that back with you and share with your employees, share with your own family, and put together a plan. So think to yourself, you don't have to raise your hand, but think about it. Have you had that long-term care conversation? We've done studies and we show that nearly half of adults haven't even discussed long-term care with anybody. And how knowledgeable are you about what long-term care truly is? Hopefully you'll learn a little something today, but in some of my conversations, a lot of people have misconceptions about what long-term care truly is. And over half of the people will probably say they're not knowledgeable enough to know how to put together a plan for long-term care. So in my story, when you hear the words long-term care, the first thing you probably think of is a nursing home. But in fact, it's not always a nursing home where somebody is receiving care. In fact, the majority of claims start off at home. And at home, you're receiving what we call informal care. So that's not a professional. That's usually a family member or friend who is providing that care to the the person who is on claim. Or you might want to call somebody and pay somebody to come into your home to provide those services. If we were able to move my grandmother back home, that's what we would have done. We would have had a professional come into the home to help take care of her, to help prepare meals, to transport her from her condo to church so that's the way she could still do the things that she enjoyed every day. So 73% of claims are going to start at home, and they're going to start with a family member or a friend being the caregiver. It's oftentimes the least expensive option. And at that time someone starts to need care, you're really looking how to manage the budget. How much is this going to cost? You're not immediately going to jump right into a nursing facility where, as we'll see here soon, how expensive that can truly be. In some instances, you might have to do that, but if you could receive care at home where you're most comfortable, most people would choose that. So this is the average cost in 2021, ranging from adult daycare to assisted living, all the way up to nursing home care. So as you could expect, nursing home, you've got semi-private rooms up to full private rooms. This can be, on average over $100,000, down to the more less expensive options of an assisted living facility, or paying for informal care. So the average length of claim is about 3.9 years. So we'll call it 4 years. So we're looking at anywhere from $75,000 over $400,000 in potential long-term care costs. And that's in today's dollars. So
and I will point out, folks, that it is more expensive even in California. Stephen, I know you're in the Bay Area. I was taking a look at places down in San Jose. Yeah, we blew by this figure. I'm not sure about, is this a nationwide average? Not to use the name Joe, but is this a national average?
This is the average across the country.
Okay. So yeah, we could be anticipating, given where my clients are, East and West Coast, Dallas, Chicago, and the Twin Cities, it could be a little bit more.
Absolutely. You throw in New York in there, it's definitely more expensive in those coastal cities. And the level of care that you want, it's also going to be more expensive. If you want to pay for 24/7 around the clock in-home care, that's going to be more expensive. So all of those add up, And if we look at that average length of claim being 4 years, and then we times that by 2 for, a couple, it could be upwards of $1 million that someone could spend on long-term care. And I think with the advancements in medicine and new technologies, the length of claim could last longer than that. So who are good candidates to start considering long-term care coverage? It's really anybody who is looking to protect assets or pass those on to the next generation. It's not just for the elderly. I think oftentimes people might wait too long or think I'm going to start looking at long-term care coverage after I retire. It's really important to consider the long-term care coverage as soon as possible. And I would say between 45 and 65, probably where you're in your peak earning years in your career, or just getting close to retirement, it's really going to increase your chances of qualifying for the coverage. It's going to help keep the costs lower. It's just like, life insurance as well. The older you get, the higher the cost. So if you can, afford coverage earlier, you're definitely going to save money when it comes to purchasing coverage earlier versus waiting later. And if you've got, or if you are an affluent couple or an individual, and you might think my plan is I'm just going to pay out-of-pocket expenses, while you probably could, is that the most efficient way? Is there a better way to leverage my dollars so that way I can pay pennies on the dollars for long-term care, and have an insurance company pay the majority of the cost? So if you're considering or haven't looked at coverage now, it's better to do that while you're young and healthy, and then consider how that cost change would happen the longer you wait. So these are the people that are good candidates to consider long-term care coverage. Now, what do most people think of when they hear long-term care? I said the first words that probably come to mind are nursing home. That's the number one word that comes to mind. But they also think, oh, it's expensive, or it's too complicated, or isn't the government going to cover that for me? Isn't Medicare or Medicaid going to cover that for me? Or you maybe have friends or family who purchased a long-term care policy a while ago and they've heard about premium increases. And people don't want to have to worry about purchasing a policy now where the cost might increase over time. So what are your options out there? So I think there's a lot of perceptions of what long-term care is, and also some misperceptions too when it comes to how it's paid for.
And I think
So
also the skeptical Joe, about there were some long-term care policies that I heard about years ago where they really didn't cover a whole heck of a lot. So your point of loss of premium and skeptical, I think, are two very good ones.
yeah, I a lot of my earlier conversations when I first got into the industry were, why am I paying for this? What am I getting out of this? Is there a better option out there? And I think it's just they didn't quite understand what they were signing up for. A lot of those policies too are actually really good, do pay out a robust benefit, but because of the way that they were priced originally, the companies had to increase the premiums. And I should mention this: Nationwide has never had to increase the cost of insurance or the premiums on an in-force long-term care block of business. But as the industry, I think it does put a bad perception on the industry there. So Timothy pointed out, the cost of care in California is a lot higher than the average cost around the country. So do you know what the cost of care is in your area? Most people won't know what that cost is unless they've experienced it from a family member who might have gone to a nursing home. So they can tell you pretty quickly, Dad, I'm paying $10,000 a month. But if you haven't experienced it, have you looked into what the cost of a nursing home is in your area? Also, people might think that Medicare is going to cover all of my long-term care expenses. I know Timothy just might have done one of these educational series on Medicare. So it's only going to cover a portion of an event that requires skilled care, and only up to 100 days. And you've got to spend 3 nights in a hospital. You've got to pay a copay. And then as soon as that condition is deemed chronic, Medicare quits covering it. This is only meant to cover a short amount of time. So don't confuse Medicare to cover a truly extended care of up to 100 days.
Yeah, good point, Joe. Yeah, we had the Medicare talk was back in June as part of the first Friday 401k conversations, and we didn't have a July conversation because the first Friday was July 5th, and I suspected nobody might show up. I would be there, but nobody else would. So that's why we're back at it. But yeah, if anybody wants a copy of the Medicare presentation, it was recorded, and I'm more than happy to share that. Back to you, Joe.
So we talked about the most common types of care, and most claims are going to start out at home and be given by somebody who is a family member or friend. And oftentimes those go unpaid. So fortunately, in my mom's situation, she was a nurse. She was working at a facility, so she had no loss of income while she was providing care, other than the times where she had to take off work to go down to Florida to be my grandmother's caregiver. So here we can see that on average, you're not only missing out on income being that informal caregiver, but you're also missing out on time. So over 31 hours spent per week for somebody who's got to take time off of work to provide that care for somebody. And that's also going to result in a loss of income. So on average, over $300,000 is lost in income for somebody who is an informal caregiver. You might think that, oh, I don't have to pay to go into a nursing home, but that person who is taking time off of work or who has to quit work to be the full-time caregiver or drop to part-time, they're missing out on income. They're missing out on time spent with family and friends as well. So I think understanding that it's not just a one-sided story for that person who's receiving care. It's a two-sided story. It's that family. It's other people are involved in this, and how does that affect them? What about the healthy spouse? How is that going to change his or her retirement goals? You might have an age gap in between there where that person might have plenty of good years left in their retirement that they want to continue to maintain that lifestyle that they have. And if they don't have a proper plan in place, one that can wipe out their retirement goals and completely change the way they spend the rest of their life. So there's about a 60% chance somebody would need long-term care. And we learned that the cost can be very expensive. And oftentimes when it comes to long-term care, Timothy, you and I, unfortunately, men are more likely to go on claim earlier. So who's going to be that caregiver? Who's going to step up? It's usually the women, or it's the daughter who's got to step up and be the caregiver. So they are most impacted on a long-term care event, not because they have to be the caregiver first, but how are they going to pay for care when they are alone or widowed? So a lot of long-term care conversations, I think women tend to be more open to that conversation because they see how it could impact them in the future. Okay, so we'll get into what long-term care costs can look like and how to implement a plan here. So we talked about Medicare and what it covers. Um, just a quick recap there. It's only going to pay up to 100 days. You've got to pay your copay for the 20 days after you've spent 3 consecutive days in the hospital. And I think that the big thing here is that once you've been deemed to be a chronic condition, which is truly what a long-term care coverage is meant to cover, that's when the Medicare stops. So Medicare is not going to cover a long-term care event. Now, how do you qualify to receive long-term care benefits? So there's 2 ways that you can qualify. You either will have to be deemed by your doctor to have a severe cognitive impairment, think Alzheimer's or memory loss, or your inability to perform 2 of the 6 acts of daily living. So your acts of daily living are, do you need help bathing, dressing, toileting, transferring, or continence? If your doctor says that you need help with 2 of the 6, then you would qualify to receive long-term care benefits. Okay. So now let's talk about how we would put a plan in place. So before we get the ball rolling here, let's look at some potential reasons as why you might want to create a plan. And this might be for some of you that are on the fence about, is it really important for me to put together a plan? So the first question you should ask is, do you have all your finances in order? Can you pay out-of-pocket expenses? Is that the most efficient way to do that? Who's going to be involved in this plan of care? Is it going to be a family member other than the spouse, such as children? Or maybe you have, a good family or neighbor who might step up and be your caregiver. Do they know that that's your plan? Make sure that you have that conversation with them beforehand, so that way they're not caught off guard. The joke is that usually the sibling who is furthest away always has the loudest voice or wants to express their opinion more than the local person who is more than likely going to be the caregiver. So make sure the entire family is involved and they're comfortable with the plan. If it's going to be the spouse, are they even physically able to be the caregiver? As obviously that might change over time. So do you need to readdress the plan and change the plan if they're not physically able to do that? If they're still working, are they going to be able to take time off of work? If they're not going to be able to do that, who are you going to pay, or are you going to be able to pay for someone to come into the home to do that? Or do I need to get into an assisted living facility? And what's that dynamic going to be like if the spouse still wants to remain in their home? And then do you want to move somewhere? So if you've got a family member or child who lives in a nearby town, are you willing to sell your home and move so that way you can get closer to somebody who can be a caregiver? How far away are from you from somebody who might need to provide care for you? And if you didn't have a plan or long-term care coverage in place, but you had other assets or other retirement accounts, what's the first thing that you would sell? I think that also provides the importance in trying to get coverage as early as possible. You can never time when you're going to go on claim or need care. So what if we're in a down market and you need to sell assets or sell stocks or sell a home in a down market? And your goal was to pass that on to the next generation. Timing of this all, you can never predict that. So putting a plan in place to help protect those assets and protect that potential timing aspect of an extended care event is an important part of considering when you're putting together your plan. And then lastly, what's this going to be like emotionally for our families? I said earlier, typically it's just one child who steps up and becomes the caregiver. Who's going to have power of attorney? And is everyone going to agree with that? And then are they going to be able to split those expenses? The local person who's providing all the care might expect the siblings out of state to chip in. Are those out of state children willing to foot that bill? So to have everyone involved in the plan of care, these are things that you should definitely be raising questions with, not only with your spouse or your financial advisor, but in your entire family.
That's a good point, Joe. Folks, yeah, my dad's looking at a care facility, not because of ill health, but at age 86, he might be getting a divorce. And Heather and Stephen, he's looking at a place in Japantown. Just the basic living expenses there, it's about $7,000 a month with a guaranteed 4% increase. That is written into the contract. And so Dad is asking me, well, how are we going to cough up 100,000 or so, plus food, plus transportation? And to Joe's point on the emotional impact, we are literally taking Dad out of El Cerrito, where he lives and has since 1972, I think, or 1970. We're putting him in Japantown. Yes, he knows where it is, but he has no friends there. But he's doing it because he feels his body is breaking down. And if he gets divorced, he doesn't have anyone to care for him. So it's stressful on us as kids, and it's stressful on Dad. And then I assume Portland, similar, Rhode Island, similar. Tough conversations to have. Go ahead, Joe.
That was the hardest part, I think, for my grandmother's situation too, is moving her from Florida back up to Ohio. Yeah, she hadn't lived there for over 30 years. While she had I have other aunts and uncles who live in Ohio as well, so it was good for them to be able to see her. But she was completely on her own, and to be going through something like that, even though her health was declining, I think that was really tough on her to have to go through that. Okay, so what are the first things that you should be thinking about when you're going to look at your plan for long-term care? First is, what are your options? What options are out there when it comes to long-term care coverage? So the good thing is that there are a plethora of options to consider, and there's not a one size fit all. There's plenty of options out there that'll fit the situation that you have. So there are traditional long-term care policies that are just long-term care. There's no other benefits paid out. So you pay your premiums. If you go on claim, you'll receive a long-term care benefit. There's also life insurance with long-term care riders. So you purchase a death benefit on a life insurance policy, and you add a long-term care rider. Once you qualify to receive benefits, you will receive a long-term care benefit, and your death benefit will decrease dollar for dollar there. So you create a fixed amount of long-term or death benefit and long-term care. The upside to that is, if you never need long-term care, you're going to have a death benefit to pass on to your beneficiaries. The other option out there are a life insurance policy, but it's leveraged more for long-term care. So this third option is called a linked benefit or a hybrid long-term care policy. These have a small death benefit and then a larger bucket for long-term care. So the upside to that is you're leveraging your dollar more for long-term care. And generally, these have inflation protection options, so you can keep up with the cost of long-term care over time. And then it still has that downside option of this: if I never need long-term care, I'm still going to get a death benefit. Whereas with a traditional long-term care policy, if you never need long-term care and you pass away, you don't get a death benefit in return. So you've got multiple options. There's also annuity options that have less underwriting requirements, that might be easier to qualify for somebody who might not be insurable for a life insurance or a long-term care policy. And then there are other ways to look at it. How am I going to fund this? So good places to look for, are RMDs from your IRAs, annuity withdrawals, using those appropriately, that you don't need for retirement. Or what about, cash or other assets that you don't need for retirement? Is there a better way to, hey, I set this money aside for, a rainy day or my healthcare fund? Is there a better way to leverage that for a more specific use like long-term care?
And to Joe's point, it really hits to a question also, folks, a larger conversation of what do you want after you pass away? Do you want to leave a legacy? Do you have one of my CEOs? I was joking with her that she wouldn't be able to spend all the money she had, and she showed me a long list of nonprofits that would get the money, provided, when she passed away. So, do you want to leave a legacy? And that may be where insurance fits in. And in case anyone hasn't figured out, I don't. I focus on retirement plans, not long-term care insurance. So I'm not here to bang the drum for anybody on long-term care, but I just want to start this conversation and roll the ball forward. Go ahead, Joe.
So I just mentioned the different options for long-term care out there. Not all of them are created equal. They've got different things that they cover. Not all of them cover the same thing or might trigger the benefit the same way. So these are definitely things that you want to consider when it comes to picking the right type of coverage for you. You talked about Medicare covering a temporary claim. Well, there are long-term care options out there that will cover temporary claims as well. So you could, for example, fall and break your hip and need care for 6 to 9 months, but you're most likely going to recover from that fully and be able to go back and live your normal life. There are long-term care policies out there that would pay the benefit out for that. Or there are types of policies that will only pay out if the condition is considered chronic, meaning you're never going to recover from that. So be mindful of the options out there. Some might provide more flexibility for you, or in that case of a chronic condition, you might think that you're going to get a benefit if you fall and break your hip, but you might not qualify from that because it's not a chronic condition. Be mindful of the cost structure. Is it easy to understand? Is there potential for rate increases? These types of policies can be designed many different ways. You can pay for it many different ways. So to keep it simple and straightforward for a benefit that you're looking to use in your potentially your 80s, you want to be able to understand, how long am I going to be paying for it? How much am I going to be paying for it each year? And is there a potential for my premium to increase? There are plenty of options available on the market today that provide a guaranteed premium, meaning your premium is not going to increase. While there are options out there that might say, here's what your premium is today, but I can't guarantee you that in the future your premium won't increase. And then lastly here, and we'll get into a little bit more detail, is indemnity versus reimbursement. So how are you going to receive these benefits when you qualify to go on claim? That's, I think, a big topic of conversation today in the long-term care industry is, how am I going to receive my benefits? What's that process going to be like? Are there hurdles I've got to overcome, or how easily am I going to receive my benefits? So what is indemnity versus reimbursement? In your indemnity plan, that means we're going to pay out 100% of the benefit. You get the entire monthly benefit, no matter what your out-of-pocket expenses were. Versus a reimbursement plan, you have to pay out of pocket. You'll have to submit receipts, and then the insurance company will determine what's a qualified expense or not. So if you have a benefit of $7,000 per month and you only spend $5,000, a reimbursement plan's only going to send you $5,000 versus an indemnity plan is going to pay you the full $7,000. So you've got that extra $2,000 that you can set aside for the future cost of care. Or maybe you want to make additional home improvements so that way you can stay at home longer. And you are going to be able to receive the full benefits on an indemnity plan, no matter what, if you're receiving care or the full benefits from multiple policies, I should say. So a good idea now, if you are younger, is to look at purchasing a smaller policy now, and then maybe look at additional coverage in the future when your finances change or you realize that you might need additional coverage. Whereas in a reimbursement plan, there might be some things that aren't covered. So to know exactly what your reimbursement plan is going to cover is important. Whereas an indemnity option, there's no restrictions on how much you can receive or what you can use that money for.
Yeah, to Joe's point, I was talking with a woman earlier this year whose parent had gone into long-term care, and it was a reimbursement plan. The issue they were having was first getting reimbursed took a long time, sometimes up to 60 days. So you pay out of pocket, you wait for the money to come. And she was finding herself arguing with the insurance company over Q-tips. I kid you not. How many Q-tips are being used on mom? It's stressful enough having a parent in long-term care and then having to argue over Q-tips. It just adds to it. So again, these are all factors to consider, and I'm sure the price varies depending upon what kind of plan you get, but never underestimate the mental cost, the emotional cost, as well as how much you quote earn per hour. What would you charge if you were working? You have to factor these things in. Go ahead, Joe.
Thanks, Timothy. And before we wrap things up and opening up for questions, Timothy and I were talking, I think beforehand, we mentioned it earlier, about government programs or the state mandated programs. So I think having a plan in place early on is going to help you avoid the dependency on government programs. I believe we had somebody in Portland who might have witnessed or been a part of the Washington long-term care mandate, where they implemented a long-term care tax for every W-2 employee. That program essentially would provide a limited benefit or a limited long-term care benefit to people who have paid into this long-term care fund. It's still going through its process of being finalized and determining whether or not that fund will be able to be maintained. But in 2020, they did implement that tax, and they are taxing W-2 employees. There are other states that are considering doing this. There's about 15 other states that are considering a similar program, not exactly like Washington. Like Timothy mentioned, California is one of them. They were probably the closest. They decided not to move forward as of today, have decided not to move forward in introducing that bill. But it could happen. Other states like New York, Pennsylvania, Illinois, and Minnesota have similar considerations about, a concern that they have for their constituents is how are they going to pay for long-term care in the future? And one way to do that is to tax. So while Washington was the first to implement that bill, there are other states that could implement something similar. And like Medicare, it doesn't provide, a very robust benefit. So I think planning ahead of time and determining what your LTC cost could be could help you put together a plan that also incorporates what those potential government plans might be to use them in combination.
Yeah, just a quick thing on California, the proposal, and again, I put it in the chat box, AB 567. The proposal was that employers and employees would pay a payroll tax. Now, for those on a tight budget, it's like, wow, another tax. And when you look at the options, and I've studied them pretty extensively, some of the options provide for a lump sum payment of around $36,000. I'm not sure exactly what that's going to do in long-term care, but as Joe said, a 3.9-year average stay, 36,000, what, a month and a half or something? It's not going to go very far. Even at the top, they were up around, I think, $118,000. Down in San Jose, where I was pricing this back in 2019, 118,000 would cover 1 year. I can't imagine 5 years later what the costs are for San Jose and the rest of the Bay Area. So California is trying, and the concern I have is that, as the expression goes, as goes California, so goes the rest of the nation. California tends to lead on change, but this one could have direct cost to an employer. Go ahead, Joe.
Yeah, well put, and I think other states are waiting for California to decide, what their plan is going to be. And while those plans put in place are definitely going to help people, and that's what it's designed to do, and it will help certain people. There are other people who might not see it that way, or pay more than what that cost of care that they're going to receive on the back end would be in taxes, and so they might not think that they're receiving a benefit that's going to be meaningful to them, especially in the future where costs might increase there. So we talked about how that the plan requires having the conversation with your family members and friends. A long-term care plan is going to help protect the healthy spouse, continue to maintain their lifestyle and their goals, and then also to be able to preserve a legacy and pass on things to your heirs that you could potentially have to sell or use to cover a long-term care expense if you don't have a plan in place. So I'll close with that and just again say to everyone, if there's one thing that you took away from today, it's about having that conversation. If you haven't had the conversation with your family members, your spouse, or even your financial advisor, now is the best time to do that. It's never too late to plan for long-term care. It's also never too early to. So I encourage you to have those conversations, look at what your options are, and then to really dig deep and understand what that coverage is, so that way you know what your plan is going to provide for you in the future. So thank you, Timothy, for having me on today, and thanks everyone for joining. If anyone has any questions, I'll be happy to answer those.
All right. Well, thank you, Joe, and Chaudhry, Heather, Jeanette, Stephen, anything and everything. Yep, go ahead, Heather.
Sure. Thank you so much, Joe. I'm somebody who actually ended up getting really familiar with long-term care last year because I had an elderly father with dementia, et cetera, et cetera. I just wanted to clarify a few things that you brought up. The 3.9 for 4-year average term, that basically is because people tend to eventually die or maybe not need it anymore. But I just wanted to be clear that that's kind of about how long people end up needing to have the care, right? Or the coverage.
Yeah, you're right, Heather. It generally, it's 3 years in a nursing home is the average stay.
Yeah.
And if you're at home, it's typically 5. And I thought about this with my mother-in-law. The reason she's, I hate to say lasted as long as she has, but it's because she's at home. She's in familiar surroundings.
Yeah.
We had a business trip. We had to put her in a care home during the day. We could not, we were in another state. Nobody could take care of her. She felt confused, neglected. She didn't know what was going on. And that was just for 8 hours until another relative could come and get her. Imagine if it was 24 hours a day, 7 days a week. No wonder people.
I have I have. My father passed away almost a year ago now, so
Yeah.
I got to see it, the whole thing unfolding.
Yeah.
But
So
you know
3
that,
years general nursing home, 5
yeah,
years at home.
yeah, and I know that part of the thing is that he had been paying for long-term care for a very, very long time.
Mm.
And so we, there was a waiting period, et cetera, and then it kicked over to that.
Mhm,
Um,
mhm.
just wondering if, Joe, if you can talk through this scenario for somebody like myself, who's relatively young, healthy, knock on wood, single, all of that, and then wants to get in and start planning for my long-term future. But then what it looks like later, if to change, or are you able to lock in at certain rates when you have the good health? And then you said later you might want more coverage. Do you then start from scratch with the rates and all that? Like, how can somebody really do the right thing and plan early without spending a bunch of money up front, and then kind of elevate their coverage later without losing all the good they had from being in good health and joining younger?
Yeah, that's a great point to make, in the fact that because it is underwritten, you do have to start over when you go to reapply. So that, I think, is the best part about doing it earlier and more and sooner, is that the cost is going to be much less expensive, but you're also able to maybe, if we're looking at it, the long-term care coverage where you can buy inflation protection,
Yeah.
you'll have that longer time horizon to where your benefit's going to grow. And so you can get a more robust inflation option, to where if you wait long enough, that inflation protection might be too expensive. And so you either have to really dial down your initial long-term care benefit. Whereas now, when you're young and healthy, you can buy a little bit more for whatever your budget is and add inflation. And that's going to keep up with the cost of, or hopefully will keep up with the cost of long-term care. So that way, later on, you may not have to buy as big of a policy. Or if you want to supplement it with something, different, you don't have to do that. You don't have to play catch up, on the back end.
So do you have any idea of the tipping point based upon history and inflation of, what length of time that makes sense for inflation being sort of a good investment up front?
When to purchase long-term care?
Yeah, well, I guess I'm saying, how many years in advance does it seem worthwhile to inevitably pay more now versus the inflation later? Just always a good idea.
The younger you are, I would say, if you're 68 and younger, inflation protection is going to make sense to purchase. And the way that I look at it is, I look at, what is my benefit going to be at age 80, age 85? That's the average time someone's going to go on claim. And this is getting more into looking at an illustration and comparing the numbers. But for the same premium dollar, let's say you buy $5,000 with no inflation. If you purchase the inflation option, your initial benefit might be $3,000, but at age 80, it'll be $6,000. So you've outpaced what the no inflation option is. And I think that's where it makes sense to buy inflation. Once you get into your late 60s and early 70s, that's when that gap shrinks. And if you've got longevity in your family, it still might make sense to buy it that late. But obviously, if you're young, you've got that longer time horizon, to where purchasing the inflation is going to create the biggest pool of long-term care around that average claim time.
One more question, and then I'll let somebody else ask something. Thank you. If I understood you correctly a minute ago, you're saying get something with the inflation control, with the inflation, adjustment, and stick with that ongoing. And then later, if you need more, potentially get a separate policy as well to do the increase. Is that what you were saying?
I think that's the option that I would consider now, if I want to start planning earlier, is, to your point, is not going all in at once. And there are the different types of long-term care insurance out there, range from inexpensive options to more, robust, expensive options. So you can purchase something anywhere on that spectrum that'll fit, you know, your financial goals there. And I would say that the long-term care industry itself is evolving and growing, which is a good thing for customers or people that are going to buy policies, because there could be a different policy or a different type of policy 10, 20 years from now that could complement the policy that you purchased today.
Thank you so much.
You're welcome, Heather. Good questions.
Heather, one thing you may also, in talking with your insurance agent, consider, which my sister-in-law did. She went with a plan that had payments for 10 years and then they stop. So it's guaranteed at, let's just say, $500,000 of long-term care insurance. She pays the same amount for the first 10 years and then does not pay. And if she goes on claim during those 10 years, her payments stop. So there's so many different kinds out there, but really it is trying to make sure you get the right amount of care dollars that you need that fits your budget.
I would say you don't want to try to cover 100% of the potential cost of long-term care. There are tools out there that you could say, here's the average cost in San Diego, and you see that a nursing home's $11,000. So you think that you need to buy $11,000 of coverage today. You know, you'll have other sources of income in retirement, or early on, you know, the care might be less expensive at home. So I would say, you know, especially in your situation, if you're not looking to buy too much now, is to not try to cover 100% of the cost of care in today's dollars.
No, we're coming up on the top of the hour. Any other questions, folks? No? All right. Well, I appreciate it. Again, Green Retirement, First Friday 401k. We'll be back after Labor Day, and this time I think we're going to be talking student loan programs. So that will be our next topic. Joe, as always, a pleasure. You take care, folks, and the recording will be made available. Bye for now.
Thanks,
Thank
everyone.
you.
Have a great weekend.